The intro countdown scene. Okay. Okay, thank you. Hey, bring some questions, and you can. Good evening, everybody. I'm Lee Seiler, also known as the Stock Doctor. Thanks for joining on your Wednesday evening. And this is the Hump Day Market Update. Thank you very much again. And we're going to go over a lot of stuff today. I'm going to try and make it within 30 minutes. Hope you can hang because there's some really important things we're going to talk about. And we are going to talk about one important thing, which I'm seeing a lot of going on because I get the phone calls from you people out there. And don't take that the wrong way, the way we're so sensitive. Not you people people in internet land that listen. Don't chase. You don't want to chase stocks. We're going to talk about that because a lot of things out there are extended. If you're patient, oftentimes they will come back to you, to your point where you're more comfortable in buying. But anyway, today is Wednesday, June 10th. We will talk more about that. And I just want a couple of things. I'm really, really, really upset with myself. And because I know better. And just to fill you in, I'm a 33-year veteran in the investment field. I've been managing assets for my own firm since the late 90s. We were doing fee-based asset management before anybody was doing fee-based asset management. Literally, so when guys were doing stock trades for commissions, say, hey, Joe, buy 100 shares of Home Depot and then charge you $150 for the trade. We weren't doing that in the late 90s. We were saying, hey, give us your assets. We'll charge you a percentage of the assets. And when it grows, we'll get our raises. And guess what? You starve for a few years, okay? Because think about this. You get $1 million account. You think, wow, that's a lot of money. It's a great account, right? Yeah, when you're charging 1.5%, it's only $15,000 a year. It does not pay the bills. So we've been doing it a long time. And my staff, I got to tell you, though, I'm proud of the way my staff has handled the bear market, which I have to tell you is the best bear market. It's been and bear markets, believe me, most of the times they're awful. Okay, the financial crisis of 08-09 was absolutely awful. It was Chinese water torture. The 2000-2002 horrendous because you had a major terrorist. Let me turn this shit down. You had a terrorist event. Even 94-95, it was a recession-ish. But it wasn't bad, but it was bad for a few months. This was bad for 4 weeks. But I'm getting the calls. When I have people call me that have no business wanting to buy this XYZ casino stock that's flying, or JetBlue, or Hilton, and it's not their objective, it's not their investment profile, not their risk tolerance, it makes me nervous because people are starting to take a little bit more risk because I'm seeing it, and all you guys on Facebook can talk about how well you're doing in the stock market, okay? Keep doing it because the stock market gods will smack you right in the face, all right? So, that being said, I want to get to my story, but first, I want to take a drink, and I want to thank our sponsors at Fuel Barbecue in downtown Sanford and The Alley in downtown Sanford. These guys are awesome, incredible people. I know them very well. Live music now has started back at The Alley, so check it out. And also Fuel Barbecue, best barbecue in town. So, to them, thank you very much. So, I've talked about this over the last few weeks on how we did on the oil trade, and basically, let me explain what the trade was. I bought an exchange-traded fund when oil was very low or negative. When you saw the news, hey, oil's trading at $2 a contract or $2 a barrel, and then negative 37 that one day. That was all paper trading, blah, blah, blah. So, anybody with common sense should have known that it's not going to stay at negative or at $2 or $3 a barrel. What happened was there was no demand. People had stopped driving. How many people didn't fill up their gas tanks for a month or two? That's what happened. And here's where us, as financial advisors, which we do this for a living, is where you earn your money. You have to be aware of those things. And what I'm proud of about my team is that we were aware of it, and we found it, and we saw that, hey, there's an opportunity. So I bought an exchange-traded fund. I didn't go out and try and pick an oil stock or a driller. I just picked a fund. And a large part of our client base received part of this fund because it was suitable for them. It may not be suitable for everybody, so not everybody got it. So it's a fund that had traded in the 20s. And it's a fund meaning it owns 30 to 50 energy stocks in it. Sure, it owns ExxonMobil, Chevron, Rig, Diamond Offshore, et cetera, Marathon Oil, all those. So I wasn't buying the commodity, I was buying the fund that owned stocks because they were all absolutely destroyed too. This fund has a history of trading in the teens to 20s. All right, at the low, you know what? I'll show you. I don't care. I will show it to you because at the low, it was the low was $3.30. Okay, so let's go there. Let's find it. And okay. And why isn't doing it? Okay, I know why. Okay, here we go. So let's pull a chart on it, and it's from a really, really strong group that sponsors this exchange traded fund, First Trust. I love these guys. Their research is phenomenal. So this is it. And the ticker symbol FXN, I can tell you now because I don't care. We own it and we've made good money on it. So down here is $3.30. And that date, let me see what the date was. That was March 20th. You know, the market bottom March 23rd, so it's right around there. So when I saw oil, that's what oil is really struggling. So we ended up buying it right around here. Okay, so that price range, and just so you know, we buy it blocks of stocks, but on average, call it anywhere in the low fours to the very little bit above 5. So from 4 to 5. All right. Then people figured out, oh geez, oil, it shouldn't be negative, because understand what that really meant to you. When oil was trading at negative $37 a barrel, so you guys want to go out and buy a contract. Well, at the end of that day, when they were expiring, they're going to give you $37,000, and they're going to say, here you go pick up your 1,000 barrels of oil in Cushing, Oklahoma. You literally and physically own 1,000 barrels of oil, and you had to go pick it up in Cushing, Oklahoma, and go store it in your pool somewhere. Okay, no. EPA probably have a little problem with that. So anyway, that being said, the fund rallied. Here we go. We're in the fives. It traded there for a little bit. So, but literally, this was purchased in April. Okay, so within no time, and on Monday, the fund was trading $8.40 on the low to $8.99 on the high. At that point, because my objective, and here's where you need to learn, folks. My objective at first was, hey, I buy it at, call it 4.5 to make it simple. 4.5, it goes to 7 by year's end. I'm really happy because that's a hell of a return. That's a 60% return by year's end. Fantastic. Then I got a little greedy and I said, you know what? I'm happy if it gets to 8 by the end of the year. Okay? It got to 8. Then on Monday, I knew better. It got to $8.99. It was in the high 8s, 8.75, 8.80, trades. So should have sold it. I knew better because I know when you have a double in 2 months, sell it because you're going to get a pullback. And then, of course, I don't sell it. Yesterday it pulls back a little bit. Today it pulls back a little more. That being said, it closed at 7.75 today, which is, we're still up 60%. But we were up either anywhere from 80 to 100% for clients, and I didn't sell out of it. And that's where a lot of people make mistakes. So the point I'm trying to make is fear and greed is what rules the market. Now, I'm going to draw a line in the sand because I can't let a 60% profit in 2 months go to a 20% profit. So I'm drawing a line in the sand, and it could be tomorrow, and I have to think about this overnight, so I'll lose sleep over it. But, I want to make my clients a lot of money, and they're going to make a lot of money on this. They are. It's just a fact of life. But it's how much? Maybe I get lucky tomorrow. And here, to make matters worse, a brokerage firm, which brokerage firm upgrades and downgrades, it's all bullshit, all right? They need to create transactions, so it's all bullshit. But somebody downgraded Chevron. Even though it's bullshit, people listen to it. So that brought the whole sector down. Anyway, so what I want to get into, some good stuff tonight, all right? And first of all, I want to make sure everybody understands that when you hear the term that things are different this time, I'm going to tell you this from my years of experience in anything. And I'm not a young man anymore. I mean, I'm 37 years old. plus or minus 20 years. But things are never different this time. People say, oh, it's different this time. But it's different this time. It is never different this time, especially when it comes to the stock market and the economy. Okay, I'm going to tell you why. Stock markets, since the beginning of time, go up and they go down. Economies expand and they contract over time. But what happens? When markets go up, they consolidate. The economy goes soft. They get in a bear market, and then they go up, and the market always hit new highs. The economy has always grown and gotten bigger. Okay, before this last 2 months when the government were idiots and shut down the economy when they shouldn't have. All right, that's stupid. And I can speak out about that. The economy and the stock market always hits higher highs. So they could say, oh, wow, 9/11, oh my God, it's changing the way we live. It's different this time because now we have to worry about terrorism. Okay, anywhere you go, there's going to be armed guards and this. Okay, what'd the market do? Move higher. Then the banks started playing Russian roulette with mortgages. 2008 and 9, and a lot of people lost their homes. Horrible. Oh, buying a house is going to be a lot more difficult these days. I mean, we're really going to have a problem qualifying for mortgages. Money's going to be tight. Banks are almost out of business. I mean, it's different this time. Guess what? Okay. Before, now, in all fairness, in 05 and 06, if you can fog a mirror or had a pulse, you can qualify for a loan. Any of you self-employed people out there ever got a stated income loan? Okay. That's enough said. Yeah, how much do I need to make to qualify for this loan? Oh, yeah, I made 120. Sure, no problem. Oh, you want me to produce a pay stub? Sure, I'm the owner of a company. No problem. Here's my pay stub. That's what happened. So, but you still can qualify for a loan if you have decent credit, you have a good job, the things that you need to have. But growth somehow does continue. And now we have this new thing. This virus that's going around where there were mistakes made, no doubt. I mean, you shut down, basically, the world shut down. Our country shut down. To me, because I told you guys a month ago that it won't be as bad as the media says, but it's probably not going to be a piece of cake either. It's going to be somewhere in the middle. And actually, quite frankly, we're probably more and more of the piece of cake side, because I don't want to, the lives lost are horrible. Yes, and I get that, and I don't want to get into that, but that is a tragedy. There's a tragedy, but it's not what everybody thought it was. Is my point. Okay, so listening to the media really, really pisses me off. Now, before I get into some strategies, I want to talk about the thing that really, really has pissed me off in the last 2 days. Growing up, if you're my age, you watch Looney Tunes, produced by Warner Brothers. Come on. Bugs Bunny, Yosemite Sam, Elmer Fudd, Wile E. Coyote. Okay. So they're doing a reboot of this, which is awesome. And I think it's fantastic. You're doing a reboot of Looney Tunes. I would probably still today, if they were on a new reboot, I would watch it. Okay. However, some rocket scientist at the cable or whoever, I don't even know who's doing it, actually probably Warner Brothers, Elmer Fudd. Now, hopefully, if you're my age, you've seen these. Elmer Fudd nor Yosemite Sam will have weapons. Okay, so they're not going to have a gun. If anybody saw the cartoons, Elmer Fudd, we're waiting for rabbits. Okay, with a shotgun of some sort. Yosemite Sam had his pistols. Oh, we're going to get you. Okay. No guns. But what they're going to do instead, they're going to let TNT be part of the destruction. So let me make sure I get this right. You can't have a handgun or a shotgun or a rifle, but you can have a bomb strapped to your torso. Okay, that makes sense to me. Anyway, it's all bullshit. All right. Anyway, so let's move forward. We are taking questions. I have several questions already. So all you have to do is you can call the office, email Nikki, and we will answer your questions. So Nikki at StockDR.com. We got Nikki and Jared here in the house. And there are a lot of people out there. Thank you very much for tuning in. Wow. And I know a lot of people will see this after the fact. So, feel free to share it with your friends. But the Federal Reserve Board today came out, and after a 2-day meeting, they discussed the economy, and they said, guess what? We're going to keep interest rates at 0 to 25 basis points. They also said they're going to use every possible tool they have in the tool belt to keep the economy growing. Here's what their numbers are for year's end. Oh, by the way, yesterday, some brain surgeon came out and said, oh, by the way, we're in a recession. Okay. Not that I have to pat myself in the back too often, but I called that in the second week of March. I said, you know what? I saw it happen in front of my eyes. March 15th, the recession started. So, whatever. Thanks, Nick. I'm getting more questions. Okay. Okay, from my friend. I am telling him, Jim, I am drinking. This is a gift from our landlord here. I'm drinking this. For my landlord here in my building complex. That's what I'm drinking. I did not tap into the good bourbon tonight. But thanks, Jim, for asking that question. That's a very important question I had to get into. So the Fed left interest rates unchanged. They have no plans of raising rates till 2022. So what does that mean to you? Mortgage rates are probably going to be pretty good for a while. So if by chance you lost your job, you have time to get back employed. Hopefully your credit didn't get hurt, and you'll be able to qualify for a loan at some point. They do expect the 2020 economy to have a 6.5% contraction for the year. Okay, I think that we know GDP in the first quarter is down. GDP in the second quarter going to be down huge. Third quarter, I still think the jury's out. I'm not sure what it's going to be, but I think that the economy probably can contract in the third quarter. And one thing that's helping is the Fed is going to be buying bonds hand over fist, okay? Hand over fist. They're buying bonds like crazy, and that's going to keep interest rates down. Unemployment, they believe by the end of the year, 2020 will be down unemployment 9.3%. Their estimate is for 2021, 6.5% unemployment, 22, 5.5% unemployment, and 23, 4.1. So it was unanimous. There's 17 Fed governors in this meeting. So they're all sitting around having a good time. Unanimous. Wow. This was pushing the envelope a little bit. It was unanimous to keep interest rates steady through 2021. However, 2 assholes out of 17 said they wanted to possibly raise rates in 2022. All right, so let's go to some questions. And let's see. So, Nikki, I'm going to go to the ones that you had. All right, we addressed what I was drinking. So let's go to the next one because I have a few other ones. Okay, Miranda Lambert. Thank you, Miranda. I appreciate you writing in. Would like to know if it's a good time to go into bonds. Okay, that's a really, really good question, Miranda. First of all, bonds, and let me give you the relationship between bonds inside a bond. Now, first of all, let me just take a step back. Let me explain to you what a bond is. A bond is where you are loaning money to an entity. You're loaning money to a company, a municipality, a government of some sort, and they're going to pay you an interest rate. You're basically the bank. So bonds are categorized as a conservative investment. And it has been for the last 40 years. When interest rates in the early 80s, and I'm sure there are people out there watching this or that will watch this, will say, wow, I remember in 1982, I had a 15% CD. How many people out there today would not cut their right arm off for a 15% CD. Because you know what? I'd probably cut something else off, but my left one for a 15% CD. So that's because rates went from 17 and now they're down to 0. So my concern is there are other ways to participate in fixed income. There's a difference between the bond market and fixed income. Fixed income can be preferred stocks, could be corporate adjustable bonds, could be high yield, could be floating. There are ways to get that more conservative piece of your portfolio, but today I would not buy a government bond. Not. Because A, you're not going to get paid right now. The 10-year Treasury yield, which bumped up here in the last couple of days, although it went down today, we'll call it ballpark here. It's 80 basis points. So what does that mean to you? That means that if you put $1,000 in the bond, you're going to get $8 a year in interest. Okay? $8 a year in interest. Awful. So what happens is, and the reason for this is the government is buying bonds and the Fed lowered rates. So when bond yields, meaning the interest rates, go higher, which they will. Right now they're low because the economy is crap, and they have to because they want to make sure people spend and use credit and buy homes and go use your Home Depot card, all that crap. But when rates start ticking up, and they will, that is, you can't guarantee a lot of things, but rates are going to go up at some point. I just don't know when, but guaranteed. When that happens, there's an inverse effect. Rates start going up, the price of the bond goes down, and here's why. So let's say today, let's make the numbers easy. You go out and buy a 10-year government bond from the United States government that has the full faith and credit of the United States government, and if you hold it for 10 years, you'll get your $1,000 back. In the meantime, they're going to pay you 1%. Let's make it simple. They're going to pay you $10. Okay? So 3 years from now, that same bond, the 10-year bond, is now giving investors a yield of 3%, which is more in the ballpark of what it normally does. So you have that bond you bought 3 years ago, and now there's a new bond, same 10-year Treasury, but it's paying 3%. Why would somebody want to buy? If you want to sell your bond, because anytime you sell something, somebody has to buy. So why would somebody buy your bond off you and only get 1% when they could buy the new one and get 3%? Anybody have any idea? Because they're not going to pay you $1,000 for it. I would say, like anybody else is a good negotiator, we'll say, okay, Joe, I'm going to buy your bond off you at 1% bond, but guess what? I'm only going to pay you $800, 80 cents on the dollar. That's how it works. So as rates go up, that's what traders do. They say, well, for me to get 1% on my money, I got to pay you less, because that brings your yield up. 1% on 800 is different than 1% on 1,000. Okay? So, Miranda Lambert, thank you very much for asking the question, but no, I would not buy government bonds right now. So let's go to the next question. And by the way, wow, there's some great people out there. I really appreciate you guys joining tonight. All right, and let me see here. Oh, my good buddy Chris Johnson's in the house, and I hate to say, hey, how you doing? But yeah, Chris, you're a great guy. So let's go ahead to the question here, and I'm going to go to the charts for this one because this is interesting. So my point was earlier when I was talking about strategies. In this market, folks, you cannot chase stocks. Do not chase them. If you're not buying them when they're getting on the upswing, and you can miss a little bit, but oftentimes, and I'm going to tell you why, because the airlines, the casinos, the cruises all took a major hit today. And why is that? They ran up big. And I assure you, there are people out there buying casino stocks today I want to own them. Casinos are not that extended, so I'm okay with that. But I want to talk about extended stocks. And I'm just going to give you examples. And I don't want you to pay attention to the names because I'm just using names, okay? And I'm going to throw out there, and let's take a look at, okay. Do I want to use that chart or not? I may want to use the other charts. They're a little bit easier to see. Hold on a second. Let's go here. Okay. A stock being extended or chasing a stock is after it's made a substantial move to the upside and has gotten above either a support level, which is an area where there are some buyers, and an area where, holy shit, we're in uncharted territory, not sure I want to own it. And I use certain tools for that. And I use moving averages, the 50, the 200, etc. This is a chart which has been a great performer and love the stock, okay? Love it, love it, love it. Love it so much, I don't own it. Okay. NVIDIA. They make semiconductors, they make chips for gaming, etc. So the stock is trading, I can't see, trading up here, $374. So it's significantly above its 50-day moving average at 309. So it's extended. So stock prices tend to trend along with their moving averages. And let's look at the history of this one. And this is what really a great point. Look at the history. NVIDIA going back a year, all right? Or it trades sideways, which NVIDIA is not one of those. It's not going to trade sideways until the 50-day meets it. So that's going to happen. So I'm going to give you an example because a stock I bought last week for clients is in the semiconductor space. I wanted to own it. I thought it was a good opportunity. I wanted to own semiconductors, but I didn't want to buy extended stocks and chase them. NVIDIA, clearly number one. So I looked at what number two was. So I went out, I bought AMD. So let me show you AMD. So here's different. AMD is not, and I'm going to show you the other chart on that because I think it's a better view on this one. Hold on, AMD. AMD is not extended. Shit, I'm going over the 30 minutes. I'm sorry. If it's okay with you guys, I'll do that. So here's the chart of AMD. AMD, yet cup and handle, look at that. Consolidation all through here. I bought it. I'll draw some lines. I bought it breaking out of this consolidation. Actually, right before it broke out. I bought it around 53 plus or minus 20 cents. Okay. It closed today at 57.44. It broke out. The volume was there, and that's what I'm looking for. So I'm looking to buy stocks that are sectors that I like, have good fundamentals, but yet aren't extended. Because what happens when you buy extended stocks is, right now, the market's extended. Market's ahead of itself. I'll show you some of those charts. Market's ahead of itself. And if you buy a stock that's ahead of itself and a market that's ahead of itself, you're going to get and if the fundamentals aren't quite there, you're going to get the trifecta of, here you go, buddy. You're going to get absolutely up to you know what. So what you look at here, let's take a look at, okay, the NASDAQ, by the way, hit 10,000. That's all big news. Okay. This is a chart of the NASDAQ. The NASDAQ's biggest stock, of course, or two stocks, are Apple and Microsoft. By the way, they're still NASDAQ stocks, also part of the Dow Jones. So look at this freaking run. Down here, the NASDAQ was 60. On March 23rd, the NASDAQ hit 66.31. Today, June 10th, the NASDAQ hit over 10,000. 10,020 just to be exact. That is a 60-70% run in no time. But let's go back to what I was talking about being extended. Here's the 50-day moving average, the red line. We are way extended, folks. So I'm really careful on what I'm buying. And anything that I buy now, I'm going to put a tight leash on it because I don't feel comfortable. So what I'm trying to tell you is, if you miss a stock, and a lot of people are calling, oh, God, we missed Carnival. Let's talk about these because I had a lot of, and I got questions on Aerojet. I got questions on Sorrento Therapeutics. I'll get to those. But I want to talk about I want to talk about the airlines and the cruise lines. First of all, okay, I tried to go the whole show hitting the wrong button, but I didn't. Okay. This is, go to Carnival. Okay. Here's a chart on Carnival. Okay. From the depths of hell, it's come back. I'd feel more comfortable owning Carnival down here, maybe in the, I gotta see here, 16, 17 level, but it's made a big run. Let's look at Delta. Delta, they make those big runs. But here's the problem we're seeing. These companies, yes, they're trading on speculation right now that business is going to be where they were prior to Corona. I'm not so sure that those businesses, I mean, think about this, okay? If you know anybody that travels for work, and now they've been surviving by doing their Zoom meetings and WebEx and all that stuff, companies are more likely to do, hey, let's do a WebEx, let's cut our prices to service the account. You're going to see that. So, I don't own the airlines. I don't own the cruise lines. I don't own the hotels. I'm not saying I wouldn't. When I say I don't, I had a client, smart client, called me last week and said, buy me some Carnival. I bought 5,000 shares for him at 17 and change. Okay, well, Carnival closed today at 20 something. I mean, I should have sold it for him yesterday, but he wanted to hold it, so it closed at 20.59. So it's a good move, but I think that they're going to be under pressure here. So what I don't want you folks to do is start hearing it's the herd effect. You hear something's been great, let's buy it. Because I'm going to go now and show you a couple questions other clients have asked. Not necessarily clients, I'm not going to tell them. My clients are smart, by the way. Okay. I have a client asking about Sorrento Therapeutics. Sorrento Therapeutics. Okay. This is a coronavirus play. It's going to be news driven. They have no earnings, no revenue. They have a pipe. It's a pie in the sky type deal. Their main focus is on pain management for cancer patients. That's their main focus. And what you're seeing now is just, they talked about Corona here. That's what the stock was at, $3. Okay. It ran from $3 to 10, and then literally and precipitously, you like those words, right? Literally, it's absolutely freaking annihilated. And now here it is at $4, $4.50. So, client calls, said, hey, what do you think of this? I said, look, I'm all for, if you want to take a speculation, it's your money, take the speculation. But what people do is they pay us to protect them from themselves. It's kind of something I try to do. I try to protect you from yourself. I have a lot of clients right now that are just wanting to roll the dice, and I don't want to roll the dice. We're making plenty of money doing it the right way. But if you want to speculate with a few $1,000, depending on the size of your portfolio, go for it. Because if they have the cure for Corona, I don't want to be the one that says, when they say, God, Jesus, trading at $500 a share now, and they're cure coronavirus, or have a vaccine for coronavirus. So that's that to me is an absolute speculative buy. I would certainly rather, because it came back down to support level right here. I'd certainly up here was extended, by the way, pie in the sky. Wouldn't want to touch that with a 10-foot pole. But now, if you want to speculate, throw some money into it, you can, as a speculation. Understand that it's not going to be, I'm going to make 10% a year. It's going to be all or none. Okay. We also got a request on Aerojet Rocketdyne Holdings. It's in the robotics business. Now, this is a company that does have earnings and revenue, and it's got strong earnings and revenue. It's about a $3 billion company. And I told, stock was down today, but I think that after the decline you saw from March, okay, this is all March 23rd BS, it traded sideways, it broke out here. I think it's coming back to a place where if somebody wanted to own it and you wanted exposure in robotics and virtual reality, it's getting to that point. They do have some earnings behind them. Some volume took it higher, and that's key here too. You want to see volume on the upside. You don't want to see volume. The key is I look at volume all the time. I track volume on all the stocks that we watch. Remember, we do individual stocks, mutual funds, and exchange traded funds. So if you want to work with us and you want somebody who really does something and doesn't put you in a model portfolio and say, have a nice day, we'll talk to you quarterly, that's not what we do. We actually manage the assets. So my point I'm trying to make is, yes, you can buy things like this, and you can make sure by, if you say, hey, I don't want to lose a certain amount, okay, you put a stop in or something to protect it. But that's kind of how it works, all right? But Aerojet Rocketdyne is probably getting close. That's AJRD. None of these are recommendations, by the way. All right, none are recommendations until you talk to somebody to make sure they're suitable for you. Okay, I can do that, but you got to call me first. Our phone number is right down here on the bottom. And first of all, I want to thank you everybody for coming out and joining us. And by the way, Skin Deep will be playing on June 19th and 20th at the Post Time Lounge, and that's going to be freaking awesome because first time playing out in quite a long time, and we're excited about that. Thank you guys for joining us. If you have any questions, please email Nikki, call the office. I'm Lee Seiler, also known as the Stock Doctor. I'll see you next week.